Welcome back to the channel. Today, we are not just looking at a stock, we are looking at the engine of the modern industrial revolution. We are going to tear down the business of NVIDIA. Picture NVIDIA as a company that sells time. Not time in a poetic sense, literal compute time, measured in how fast you can train a model, run a simulation, render a scene, search a database, or infer an answer. When compute time becomes the bottleneck for making money, the vendor that can reliably shrink that bottleneck becomes insanely valuable. That's the core of NVIDIA's business model in the AI era. It doesn't just sell chips, it sells an entire way to turn electricity into useful work, at scale, fast, and with a developer ecosystem that makes switching away painful. Now let's take NVIDIA apart from the ground up, how it makes money, why its moat is real, what its culture and leadership look like, how healthy the financial engine is, and how you can think about valuation and margin of safety without fooling yourself. NVIDIA's business model today can be summarized in one sentence: it captures a large share of the total AI factory bill of materials, not just the GPU line item. Years ago, people thought NVIDIA was mainly a graphics card company, PC gaming, some professional workstation graphics, and a side hustle in data centers. That old picture is outdated. In its latest reported quarter, NVIDIA reported total revenue of $57.0 billion, and data center alone was $51.2 billion. That tells you what business NVIDIA is really in right now. But the important nuance is how the data center revenue is created. It's not just selling standalone GPUs into servers. NVIDIA increasingly sells full platforms, GPU plus high-speed networking plus systems plus software plus support plus sometimes cloud services. You can think of it as moving up the stack, from component supplier to platform owner. Start with the hardware layer. NVIDIA's accelerators are designed for the kind of parallel math AI loves. But a single GPU isn't the product anymore. The product is many GPUs behaving like one machine. To do that, you need a fast interconnect inside a server, and you also need extremely high-performance networking between servers. This is why NVIDIA's networking business matters. It's a key piece of getting thousands of GPUs to act like one coherent training system, rather than a slow, fragmented cluster. Then comes systems, racks, reference architectures, superpods, and enterprise-grade integrated solutions. NVIDIA positions DGX and related platforms as a standard for enterprise AI infrastructure, essentially pre-validated building blocks for organizations that don't want to reinvent the data center every time they adopt a new model. Then comes software, and this is where NVIDIA's business model becomes much more than sell a chip. NVIDIA's ecosystem includes CUDA, libraries, toolkits, and enterprise software suites. CUDA isn't a single product, it's the runtime, compilers, debugging tools, and GPU-optimized libraries that turn theoretical hardware performance into real application performance. If you've ever watched two machines with similar paper specs perform wildly differently on real workloads, software maturity is usually why. NVIDIA's CUDA toolkit and its ecosystem exist to make NVIDIA performance show up in real code, not just in marketing slides. On top of that, NVIDIA increasingly sells enterprise software under licensing models. For example, NVIDIA AI Enterprise is positioned as a cloud-native suite of tools, libraries, containers, and microservices for building and running AI in production, and NVIDIA's enterprise licensing documentation describes licensing on a per-GPU basis for certain enterprise software packages. That matters because it's the bridge from cyclical hardware revenue into more recurring, higher-margin software-like revenue streams. So if you zoom out, NVIDIA's commercial engine looks like this. They create the fastest general-purpose AI compute platform. They make it easy to adopt via software. They make it easy to scale via networking and systems. They monetize across multiple layers: chips, networking, systems, software licenses, and services. That's why the AI factory framing is so useful. When a hyperscaler or enterprise builds an AI training cluster, they're not shopping for one GPU. They're buying a stack. NVIDIA aims to own the stack, or at least own the most irreplaceable parts of it. Now let's map that into the simplest business model breakdown: who pays NVIDIA, for what, and why they keep coming back. Who pays? The biggest payers are cloud service providers and hyperscalers building AI infrastructure at massive scale. Then you have enterprises, banks, pharma, industrials, governments, who increasingly want private or hybrid AI systems. Then you have the traditional businesses, gaming GPUs, pro visualization, and automotive embedded. What do they pay for? They pay for performance per watt, performance per dollar, and time to deployment. They pay for reliability, supply, and ecosystem stability. They pay for compatibility. Will my models, tools, and engineers work on this? They pay for scale. Can I go from 8 GPUs to 8,000 without rewriting everything? Why do they keep coming back? Because switching costs in this space are not just swap vendor A for vendor B. Switching means rewriting kernels, retesting performance, revalidating reliability, retraining engineers, retooling deployment pipelines, and potentially taking a big hit in model throughput. That switching cost is one of the strongest economic levers NVIDIA has. And that takes us to the moat. NVIDIA's economic moat is not one moat, it's a castle with multiple walls, and you have to evaluate them together. The first wall is the developer ecosystem moat, CUDA, and the surrounding software stack. It's fashionable to say, CUDA is the moat, and that's directionally correct, but the deeper point is this: CUDA is not only a toolchain, it's an accumulated advantage. Over time, NVIDIA has built libraries and optimizations that encode hard-won knowledge about how to get real performance out of GPUs for specific workloads. That kind of compounding is brutally difficult for competitors to replicate quickly. Also, CUDA isn't static. It evolves as architectures evolve. That matters because the moat isn't just developers learned CUDA once. The moat is that NVIDIA has been the default target platform for accelerated computing for so long that new tools, frameworks, and research often assume NVIDIA support first. You can see the industry acknowledging this lock-in effect even in the way competitors and startups market themselves. There are startups explicitly trying to break NVIDIA's chip lock-in by making CUDA workloads portable. The very existence of that category is evidence of a moat. If CUDA didn't matter, nobody would pay to escape it. The second wall is the platform integration moat, compute plus networking plus systems. This matters because AI training at the frontier is increasingly a networking problem as much as a chip problem. When you scale training across many GPUs, your bottlenecks shift: memory bandwidth, interconnect bandwidth, latency, synchronization overhead, and cluster utilization become the difference between a profitable data center and a money-burning furnace. NVIDIA has positioned itself so that when you buy NVIDIA, you're buying a coordinated set of components designed to work together. This platform integration creates two advantages: one, performance and efficiency advantages that are hard to match with a mix-and-match approach, and two, a procurement advantage. Buyers love fewer integration headaches. The third wall is the pace of innovation moat. In semiconductors, staying ahead is often about executing a product roadmap reliably: architecture, packaging, memory, interconnect, power delivery, software enablement, developer relations, and manufacturing coordination. NVIDIA's strategy explicitly frames innovation as happening across multiple layers: architecture, chip design, systems, interconnect, algorithms, and software. This matters because a competitor can sometimes match you on one dimension, say raw compute, but still lose in the total system, the software, the time to market, or the ease of deployment. The fourth wall is customer entrenchment and default choice dynamics. Once a company standardizes its AI platform, budgets and internal processes reinforce that choice. Procurement teams want predictable supply. Engineers want stable tooling. Leadership wants predictable delivery schedules. A platform that's good enough and widely supported becomes the default, and defaults are incredibly sticky. The fifth wall is economic and scale advantage. NVIDIA's scale gives it leverage. It can invest more in software, developer tools, partnerships, and ecosystem growth than smaller rivals. It can also justify building specialized solutions because it knows it has enough market to amortize development costs. Now, no moat is invincible. So to be fair, you also have to understand the pressure points that could weaken NVIDIA's castle. The obvious threats are: 1. Competition from AMD and other GPU vendors, 2. Custom silicon from hyperscalers, 3. Open software ecosystems that reduce lock-in, 4. Export controls and geopolitical restrictions, 5. Architectural shifts, 6. And demand cyclicality if AI spending slows. The interesting part is that these threats can be real, and yet NVIDIA can still be a great business, because it doesn't need to win 100% of AI compute to generate enormous profits. It just needs to keep enough pricing power and enough ecosystem dominance to preserve attractive economics. That brings us to the question everyone really cares about: does NVIDIA have pricing power? The best evidence of pricing power is gross margin and the ability to sustain it while scaling revenue massively. In fiscal 2026 Q3, NVIDIA reported GAAP gross margin of 73.4%. That's not a commodity hardware profile. That's a platform owner profile. High gross margin in hardware-heavy businesses usually means one or more of these things are true. The product is differentiated enough that price competition is limited, customers care more about outcomes than unit price, or the vendor owns enough of the stack to capture more value. In NVIDIA's case, it's all three. Now let's move from the moat to the culture and management, because the how behind execution matters enormously in tech. NVIDIA's management and culture are often described through Jensen Huang's leadership style. He's not just a CEO, he's the founder-operator who shaped the company's identity over decades. One cultural principle that frequently comes up in discussions of NVIDIA is intellectual honesty, the idea that teams should confront reality, admit mistakes quickly, and learn faster than competitors. Profiles and commentary around NVIDIA's culture often point to Huang's willingness to acknowledge errors as a core cultural feature. Whether you like the personality-driven narratives or not, the business relevance is straightforward. In fast-moving markets, the companies that survive are the ones that detect reality early and adjust without ego. When cycles shift, crypto booms, gaming downturns, AI explosions, execution and adaptation matter more than perfect forecasting. You can also look at NVIDIA's formal values through its code of conduct and corporate policies, which emphasize core values and expected behavior. That's not unique, every major company has a code, but it provides a baseline for how NVIDIA wants to present its internal operating philosophy. Management quality also shows up in capital allocation. For example, NVIDIA has been returning significant capital to shareholders while still investing aggressively. In the first 9 months of fiscal 2026, NVIDIA returned $37.0 billion to shareholders via repurchases and dividends, and it reported $62.2 billion remaining under its share repurchase authorization as of the end of fiscal 2026 Q3. That's a signal of confidence in cash generation and in the long-term earnings power of the business, though, as we'll discuss later, buybacks at high valuations can be a double-edged sword. Now let's talk financial health and profitability, because a moat only matters if it turns into cash. The first headline is revenue scale. NVIDIA reported $57.0 billion revenue in fiscal 2026 Q3, up 22% sequentially and up 62% year-over-year, with data center at $51.2 billion. The second headline is profitability. That same quarter included GAAP gross margin of 73.4%. The third headline is cash generation. NVIDIA's Q3 fiscal 2026 reporting includes a cash flow table showing net income of $31.910 billion for the quarter. Even without diving into every line item, the combination of massive revenue, extremely high gross margin, and very large net income tells you the business is currently operating in a highly favorable demand environment with strong pricing power. Now, financial health isn't only about profits. It's also about resilience. So you want to check how dependent they are on a small set of customers, how exposed they are to a single end market, how sensitive they are to supply constraints, and how geopolitical restrictions could hit demand. On that last point, the reality is that export controls and policy restrictions can affect where NVIDIA can sell advanced AI chips, and news coverage around China-related approvals and restrictions continues to be a factor in how investors price the risk. In other words, NVIDIA's demand may be huge, but it's not frictionless demand. Policy can shape addressable markets in ways that are hard to forecast. Now, let's translate all of this into a clean mental model of NVIDIA's profitability engine. If you simplify the business into an AI factory supplier, the profitability levers look like this. 1. Compute demand grows customers by more accelerators. 2. Accelerator scale grows networking becomes essential NVIDIA sells networking too. 3. System complexity grows customers prefer integrated platforms NVIDIA sells systems and validated architectures. 4. Production deployments expand software and support matter more NVIDIA sells enterprise software suites and services. This is a compounding flywheel. The bigger the AI workloads get, the more valuable the full stack becomes, and the more NVIDIA can capture per deployment. Now let's confront the part that matters most for investors: valuation and margin of safety. As of the latest market snapshots around early to mid-December 2025, NVIDIA's market cap is roughly in the $4+ trillion range depending on the day, and valuation metrics commonly cited include a trailing PE in the mid-40s and a forward PE in the low to mid-20s range. Those numbers sound contradictory at first. Why would trailing PE be much higher than forward PE? Because Nvidia's earnings have been rising rapidly. When earnings explode upward, the E in the PE ratio catches up, and the forward multiple compresses, if analysts expect earnings to keep growing. So the right way to think about Nvidia valuation is not, is 45x trailing expensive? It's how durable is the earnings power, and what growth rate is the market pricing in? Here's a simple way to do that in plain language. Imagine you're paying a high multiple today because you believe Nvidia's current earnings are not the steady state. You believe the company is still climbing the earnings curve, either because revenue keeps growing, because the mix shifts toward higher margin platform revenue, or because operating leverage kicks in. In that story, high valuation can be justified. But it also means your margin of safety is thin, because the stock price already assumes a lot goes right. Margin of safety is basically the gap between what has to happen for you to not lose money, and what you think will happen. For Nvidia, the what has to happen bar is high because the market price embeds strong expectations. So instead of pretending you can calculate an exact intrinsic value, you can evaluate margin of safety using scenario ranges. Try 3 scenarios. Scenario A, AI demand stays strong, but growth normalizes. Revenue still grows, but the growth rate slows as the base gets huge. Margins remain strong but stop expanding. In this case, Nvidia can still be a phenomenal business, but the stock could underperform if the market was pricing in faster growth. Scenario B, AI spending stays strong and broadens. AI expands beyond hyperscalers into enterprises and sovereign AI initiatives. Nvidia keeps selling full-stack platforms. Software and services become meaningfully larger. Margins stay very high. In this case, a premium valuation may be sustainable, and upside remains. Scenario C, AI CapEx digestion cycle hits. Customers pause spending to digest capacity, optimize utilization, and wait for next-gen systems. Growth slows sharply for a period. Investors re-rate the multiple downward. In this case, even if Nvidia remains dominant, the stock could fall meaningfully because valuation compresses. Here's why Scenario C is not crazy. AI infrastructure is capital intensive, and even the broader market has been sensitive to signs of AI trade cooling or CapEx overreach. When big buyers report spending strains or market jitters rise, it can spill over onto Nvidia sentiment even if Nvidia's own numbers remain strong. So what is the practical investor takeaway? If you want a large margin of safety, Nvidia is often not the textbook candidate during boom conditions, because the price usually reflects the boom. But no large margin of safety doesn't mean bad investment. It means you need a different approach. Either you have a long time horizon and accept volatility, or you wait for drawdowns when narrative fear spikes, or you size the position modestly relative to portfolio risk. Now, let's make this more concrete. What would you watch to judge whether Nvidia's moat and profitability are holding up, and therefore whether valuation is justified? Watch metric 1, data center revenue growth and mix. This is the heart of the story. In fiscal 2026 Q3, data center revenue was $51.2 billion out of $57.0 billion total. That's extreme concentration. Concentration isn't automatically bad, but it means your thesis is basically AI infrastructure keeps expanding. Watch metric 2, gross margin stability. Gross margin around 73% is telling you Nvidia is not in a commodity fight right now. If gross margin starts falling materially and persistently, it can signal pricing pressure, competitive intensity, or unfavorable mix shifts. Watch metric 3, supply and product transition execution. In platform businesses, transitions can be dangerous: new architecture ramp, manufacturing yield issues, software compatibility, customer validation cycles. Nvidia has so far been praised for executing transitions and maintaining demand, but every cycle brings risk. Watch metric 4, networking and systems attach rate. If Nvidia keeps increasing the share of AI factory spend it captures, that's a moat reinforcing itself. Platform attachment is one of the best hidden drivers of long-term economics. Watch metric 5, software monetization traction. The more Nvidia can sell software and enterprise subscriptions attached to GPUs, the more durable the cash flows become, and the more the business looks like a hybrid of hardware and software. NVIDIA's positioning around AI enterprise and enterprise support shows the direction they're pushing. Watch metric 6, customer concentration and competition signals. If hyperscalers meaningfully shift workloads to internal chips, or if alternative ecosystems mature enough to reduce CUDA lock-in, that can change the long-term slope. The fact that others are trying to create CUDA portability layers tells you it's not impossible, but it's also not easy. Now let's talk about risks in a more grounded way, because every great story has a shadow. Risk 1, the customer capex cycle risk. Even if AI is the future, spending is not linear. It comes in waves. When spending pauses, the market tends to punish the most visible winners the hardest, because they're priced for perfection. Risk 2, competition that is good enough. NVIDIA doesn't need to be beaten to be harmed. If alternatives become good enough at lower cost, some buyers will diversify. The key question is not, does NVIDIA lose leadership? But does NVIDIA lose pricing power? Risk 3, geopolitical restrictions. Export controls can remove chunks of addressable demand or force product redesigns and segmentation. This is hard to model and easy to underestimate. Risk 4, platform complexity and execution risk. As NVIDIA sells more complete systems, it takes on more operational complexity, supply chain coordination, support obligations, system-level validation. That can be a strength, but it's also a broader surface area for execution mistakes. Risk 5, valuation risk. Even a perfect business can be a bad investment if you pay too much. When the narrative is universally loved, the margin of safety is usually lowest. So how do you think about safety margin for NVIDIA, specifically? A practical approach is to define safety margin not as a single intrinsic value discount, but as a combination of entry price discipline, time horizon, and thesis strength. Entry price discipline, you look for moments when fear spikes and the price offers better forward return potential. Time horizon, if you believe AI compute is a decade-long platform shift, you can accept that the stock may be volatile year to year, but the business trajectory could still win. Thesis strength, you constantly recheck whether NVIDIA's mode is weakening. If CUDA lock-in weakens, if customers meaningfully shift away, if margins compress, or if platform attachment stalls, you update the thesis. Now let's tie everything together into a clean, investment-grade narrative you can actually say out loud. NVIDIA is not just the world's most important chip company in AI. It's building the operating system of accelerated computing. It sells the picks, but also the shovels, the power tools, and the instruction manual. Its business model is powerful because it monetizes a full stack: GPUs, networking, systems, and software. Its moat is real because software ecosystems compound over time, switching costs are high, and system-level performance is hard to replicate quickly. Its culture, shaped heavily by a founder CEO, emphasizes speed, learning, and execution, traits that matter in a market where product cycles define winners. Financially, the company is producing numbers that look more like a software platform than a traditional hardware vendor: massive revenue scale, very high gross margins, and extraordinary profitability in its most recent quarter. But the market knows this, and the stock is priced accordingly. Valuation metrics in late 2025 imply that investors expect a lot of that strength to persist. So the margin of safety is not something you get for free. You either earn it through patience on entry price, or you accept lower margin of safety in exchange for long-run exposure to what might be a historic platform company. If you want one final mental picture, make it this: NVIDIA is building AI power plants. Not the electricity grid, the compute grid. And right now, they are selling turbines, control systems, cooling systems, and the software that makes the plant productive. As long as the world keeps building AI factories, NVIDIA has a path to keep printing cash. The only real questions are how smooth that growth path will be, how much competition erodes pricing power, and how much you're willing to pay today for tomorrow's dominance.